A very good day to all of you. Today I am going to discuss about the concept and nature of financial services. So today we will start with the concept and nature of financial services. The financial services sector in India is blooming and has become one of the lucrative areas to professionalism. The sector has undergone metamorphosis since 1990. Indian economy got liberalized during 1991 and the financial sector was kept open for private and foreign players. As the new economic policy was launched in the year 1991 under the leadership of P.V. Narasimha Rao. So this policy opened the door of the Indian economy for the global exposure for the first time. And in this new economic policy, P.V. Narasimha Rao government reduces the import duties, opened reserve sectors for the private players, and devalued the Indian currency to increase the export. That's why this is also known as the LPG model of growth. LPG stands for Liberalisation, Privatisation, and the Globalisation. The main purpose of new economic policy refers to economic liberalization or relaxation in the import tariffs, deregulation of markets, or opening the markets for private and foreign players, and reduction of tax to expand the economic wings of the country. The former Prime Minister Manmohan Singh is considered to be the father of new economic policy of India. Manmohan Singh introduced the new economic policy on 24th July 1991. And during the late 80s, the Indian financial services industry was dominated by commercial banks and other financial institutions governed by the central government. And the economic liberalization has brought in a complete transformation in the Indian financial services industry. As you can see in the image, the policy was launched by the government of P.V. Narasimha Rao, and the father of new economic policy was the Manmohan Singh. The first branch of the new economic policy is the removal of industrial licensing and registration. As previously the private sector had to obtain license from government for starting a new venture. With the help of this policy, now the private sector has been freed from licensing and other restriction. So the financial services sector can now easily do the transactions. Second branch of the new economic policy is the privatization. As privatization means permitting the private sector to set up industries which were previously reserved for the public sector. And under this policy, many public sector units were sold to private sector. Means privatization is the process of involving the private sector in the ownership of public sector units. So this helped the private sector to came into the action and can work freely. The main reason of privatization was in currency of public sector unit are running in losses due to political interference, and the managers cannot work independently. So this privatization process help many sectors to work freely under their own ownership. The third and last branch of the new economic policy is the globalization. Globalization means to make global or worldwide, otherwise taking into consideration the whole world. Broadly speaking, the globalization means the interaction of the domestic economy with the rest of the world with regard to foreign investment, trade, production, and financial matter. So this also opens the door to go abroad and do the transactions. As before 1990, this financial service sector was dominated by commercial banks and other financial institutions, as both the institutions are governed by the central government. So other financial institutions are the saving and loan associations, investment banks and companies, brokerage firms and insurance companies. So prior to economic liberalization, the Indian financial service sector was characterized by various other factors which was related to the growth of this sector, and some of the factors of significance are as follows. Following are the factors responsible for not growing. First factor which is responsible for not growing the financial service sector is too much of control and regulation by the apex body in the form of interest rates and money rates. As during late 80s, the control and regulation was in the hand of central government, so they bound the private institutions to not work freely, as they imposed high interest rate and high money rates. Another factor is too many control over the prices of securities under the erstwhile controller of capital issue. Earlier, the controller of capital issue is in the hand of central government, so they are having control over the prices of the securities. Next factor is non-availability of financial instrument on a large scale as well as on different varieties. There were very less financial instruments available in the market, and we can't find the different varieties of financial instrument. Next factor is the absence of independent credit rating and credit research agencies. Earlier, the credit rating agencies were not independent, or we can say there is no credit research agencies available who is rating the instruments or who is rating the financial instrument of the institutions, so it can't gain the trust of the investors. Strict regulation of the foreign exchange market. There were many restrictions on the transactions of foreign exchange. There are a number of formalities which the people has to do while doing any foreign exchange transactions. Restrictions on foreign investment and foreign equity holding in India. During late 80s, there were many restrictions were imposed by the government on doing foreign investment, or if any person who is interested to invest in foreign equity, then they have to fulfill many criteria. Next factor responsible is the lack of information about international development in the financial sector. There were very less people who were aware about the developments of financial sector. Maximum of the people were not aware about the international development of the financial sector in India. Next factor responsible is the absence of developed government securities market. Earlier, there were very less developed government securities are available in the market. Next factor responsible is the existence of a stagnant capital market without any reformation. So we can say that in earlier there were stagnant capital market, and that too is with little reformation. Last factor which is responsible for not growing the financial service sector in India is the non-availability of debt instrument on a larger scale. Earlier, there were very less instrument available into the market, and in which the debt instrument was not found on a larger scale that bound the financial service sector to grow into the area. However, after the economic liberalization, the entire financial sector has undergone a seesaw change, and now new financial instruments are entering the capital market on a daily basis. The present scenario in the Indian capital market is characterized by two terms, and these two terms are financial innovation and financial creativity. Thank you everyone. That's all for today. We will be meeting in the next session. Thank you.